Everyone treats the stock market like a slot machine, but have you ever wondered how the billionaires actually stack their billions? Spoiler, they're playing a different game entirely. Stick around for 3 minutes and I'll show you the one strategy that separates the gamblers from the truly rich and which side you want to be on. Scroll your feed and it's rocket emojis. I turned $500 into a Lambo screenshots and strangers promising 10x returns by Friday. Looks fun, right? So you download a broker app, smash buy on a ticker you can't even pronounce, and boom, you're a trader. Except the math isn't impressed. Study after study, from Sao Paulo to Taipei to Texas, finds the same brutal stat. Only about 1 to 3% of day traders beat the market after costs. Everyone else is basically donating to brokers, market makers, and Uncle Sam. Every click shaves off a crumb. Leave the plate out long enough and the whole sandwich disappears. If trading feels like a casino, that's because for most people it literally is, and the house loves a frequent visitor. While you're staring at 5-minute candles, BlackRock and Vanguard are thinking in 5-decade chunks. They buy whole zip codes of the economy, hold forever, and let compound interest do the reps. Because they're pushing trillions, they negotiate fees that look like typos, 0.02%, 0.03%. They also own the best data, the fastest pipes, and the political umbrella of being too big to fail. When they do trade, they slice orders so thin the market barely burps. Retail guys never see it, but they feel it when a stock gaps 8% overnight on nothing but a quiet index rebalance. Big money moves slow, and that's the whole trick. Picture this. You auto-deposit $100 a week into a plain vanilla S&P 500 index fund, then forget the password. Historically, that's delivered about 10% a year, turning that weekly C-note into just under 7 figures after 3 decades. No 3 a.m. chart vigils, no margin calls, no $2,000 chat room subscription. Warren Buffett didn't get rich flipping penny stocks. He bought great businesses and let their profits snowball. Leave $10K alone at 10% and it doubles roughly every 7 years. Compounding loves silence. Every trade is a door slam. Compare 2 accounts. Trader A makes 50 round trips a month, pays $5 plus spread each time, and needs a 12% gain just to break even on costs. Investor B buys once, pays 0 commission, captures the market's 10%, and doesn't owe taxes until she sells years later. One's swimming upstream against friction, the other's floating downriver with the tide. Institutions mint money by owning the river and charging tolls. Individuals mint money by buying a boat ticket and staying on deck. The hedge fund legends you read about. They're either running code that looks like alien math, or they're the lucky ones who survived a Darwinian filter. For the rest of us, the smart seat is on the investor side of the table. I'll invest 90% and play with 10%, cute idea, until behavioral economists show that play money gets gambled twice as hard and losses get doubled down. That 10% sleeve becomes a gateway drug that drags total returns lower. Every minute you babysit the fun account is a minute you're not learning a new skill or crushing it at work, your biggest asset by far. Still itching? Cap the sandbox at 5%, track it honestly, and look back in 5 years. 99 times out of 100 the index wins, and you'll sleep better knowing the rent isn't riding on a candlestick. Flip a stock for a quick $10K gain, and the IRS treats it like a paycheck. Up to 24% gone before you brag on Twitter. Hold an index fund for decades, and you defer the bill the whole time, letting the pre-tax balance keep doubling. On a 10% base, deferring a 24% tax for 30 years is the same as boosting your annual return by roughly 1.5%. Fees do the same damage. 1% a year eats almost a third of your pot over 40 years. Pick a fund charging 0.05%, and you just bought yourself a beach house upgrade in retirement without taking extra risk. The top predictor of future wealth isn't IQ, timing, or even salary. It's the ability to sit on your hands. Markets wobble, headlines shriek, your cousin texts, "I'm up 300% on calls," and you do nothing. That discipline beats any insider tip. Trading hands you the dopamine hit of feeling in charge. Investing actually gives you the wheel, then whispers, "Let go of it." Wealth is built on moves that feel boring today and look brilliant in hindsight. And remember, lose 50% and you need a 100% gain just to get even. Avoiding the big wipeout beats swinging for the fences every time. If this is clicking, hit like so the next person Googling hot stock tips finds this instead. Subscribe for more no-fluff money videos. Your future self will high-five you. Step 1. Automate. Pick a broad, low-cost index fund, root part of every paycheck there before you see it. Then freeze the debit card. Step 2. Ignore. Read a novel, hit the gym, learn sourdough, anything except watch prices. Once a year, rebalance by tossing new money at whatever's underweight. Done. Want extra credit? Tilt a sliver towards small cap value or global REITs, but never more than you can stomach cutting in half. Follow those 2 steps for 30 years and you'll beat 90% of hedge funds without ever Googling Greeks. Real money isn't made by outsmarting the market, it's made by outlasting it. Trading versus investing. Where's the real money? For almost everyone, it's on the right side of the clock, years, not nanoseconds, owner, not renter, compounder, not flipper. The casino profits on volume, billionaires profit on patience. Pick your table wisely because time is the card that always wins. Grab the boring chair, plant your tree, and let the years pay you the richest returns on earth.